is up, everybody, and welcome back to the Fresh Finance Podcast. My name is Thomas Elms. I've got my co-host here, Kyle Ryan, as always. And today we are going to do a little bit of a recap of everything that's really kind of gone on in the third quarter that's important to consider. And we're also going to kind of transition a little bit into a brief look into the future of what we might want to be expecting, be looking out for in the fourth quarter, as well as, Kyle, essentially, the third quarter has been highs of highs and lows of lows here for a minute. And I know that we'll kind of get through that, but evaluating what some of this stuff will ripple out into or possibly ripple out into in the fourth quarter. And one of the things that we are really going to try and hit on that is timely as of right now is the strikes going on the auto side of the American economy. So Kyle, would love to just kind of get your initial thoughts on the third quarter in relation to just kind of how it stacks up to the first half of the year, I would call it, through essentially what's been probably one of the craziest market cycles from like a 1 to 2 year period in a long time.
Yeah, thanks, Travis. It's been really volatile. In order to do a third quarter recap, we really have to touch on a lot of the big news events that happened in the third quarter. Namely, there was a lot of strikes that went on. We just dealt with the government shutdown that was passed on the 11th hour and at the 59th minute, almost literally. So we'll definitely touch on those, but it's kind of in the same tail of the tape that we've seen for the better part of the last 20, 22 months. In that there's just been a volatile market. The market is expecting one thing, the Fed is saying another, consumers are experiencing something completely different than both of what they're saying. So, we're just dealing with increased volatility. Sometimes earlier in the year, the first half of the year, market was growing really well. The economy's been growing really well. One of those changed. Been following the market, it's the market. The economy is still growing really well. But the third quarter, we gave some back in the market, notably in August and September, which September historically is the worst month of the year. So we're too surprised by that. But it's just been a really volatile quarter so far.
Yeah. And I think, another thing to kind of set what I would say, just kind of setting your sights or setting your expectations on is the reality is the outlook for this year was pretty flat, was pretty neutral. Now, obviously, we don't want to put too much stock into what people are thinking about a next whole year is going to look like, but that was kind of at least our team's general expectation on the market, is we were going to be anywhere from that, like, even negative, like down 5 to maybe up 5 range. We didn't think there was going to be too much price action, but the reality is, we saw a huge recovery in the first half of this year. And the reality is we're kind of just sinking back to that norm. And I think that was just, a major situation with a lot of the chip manufacturing, kind of those types of companies that really excelled, some of the super large companies that excelled, first and second quarter, and the third quarter was just a bit of a reprice on that. So I think kind of just coming back to ground zero and, setting your expectations along with what you talked about, which I kind of do want to focus on right now, is this auto strike, and it's really the auto strike, but there's also, the Guilders Act, or what the Actors Guild, sorry, which is more on the movie production, film side that's also happened. We're seeing kind of this stagnation between these two different groups where, we've got employees that are kind of getting to a point where like, hey, we need increased wages, which has become a really heavy conversation with how high inflation's been at. And we're kind of starting to see people and unions legitimately stopping work to try and fight for that. So, there's definitely a lot of play on how that affects the economy. I'd love to just kind of get your take on that.
Yeah, the strikes have been really interesting, right? In order to get a better understanding of the strikes, we kind of have to go back to that 2020 COVID mindset, because what was really happening in 2019, the years leading up to the pandemic, was the economy was growing really well. There wasn't too many, huge issues in the economy. So naturally what happens, and what was the trend of that 2010 decade, was wage growth was not keeping up with the growth of the economy and the growth of companies in their profitability. So when you have wage growth lacking behind and something like the pandemic comes along and it just reshifts the global values, right? Your global values as to what your work-life balance is. A lot of these strikes are about, the amount of sick days that one gets. So like that was the trains, right? So the freight strike, they just simply weren't getting enough sick days. So from the employee side of the economy, it's been a really big refocus on the work-life balance and employee benefits. So take that into consideration. Now we go into 2020, we hit the pandemic, come
Yep.
out of 2020 and see record growth year over year. So what happened in the environment we're in now is we have very low unemployment. Wage growth is sort of catching up, and there's a lot of open jobs out there. So what happens is you have this, this power relationship between employers and employees. And for the better part of almost since the beginning of the pandemic, that power shift has been in the employee's favor. Gives you
Hmm.
more bargaining power when you're discussing your employer, how much you get paid. We all know that unions represent a large handful of an industry. Some of the biggest ones are notably the United Auto Workers. There's such other ones as the teachers. There's the Teamsters with UPS. There's a lot of different unions out there.
Yeah.
They all have their own bargaining power. So what's happening is because we have this really tight labor market and because the employees have so much bargaining power on their side, they're able to say, hey, you know what, we had a couple years where we had low expenses. We got a lot of income from the government or whatnot. There's a lot of higher savings right now. We can afford to take the chance and go out there and demand our own higher wages, demand better benefits. And we're
Hmm.
seeing that across the board in all these different strikes. You mentioned the one, the Writers Guild. I mentioned a couple others, the UPS, airlines, right? So I think it was Delta who got into contract disputes. They got it settled, and then a different airline company got into contract disputes,
Yeah.
settled for better than Delta, and Delta went back to the board and like, we want more actually. Um, so a lot of these strikes are going on because employees want better benefits. Power to them. But
Yeah.
there is a serious impact on the economy that you mentioned. This is what the look forward basis is. If you go on strike and it's quickly resolved, it really doesn't have that much economic impact unless the resolution of that is dire to the economy somehow, some way. But the real impact of a strike can be when there is no resolution,
Yeah.
right? So if they go out of work for 2 weeks and they're not creating any more cars, they're not building any more cars, what happens? There's so many different impacts. For one, all the businesses in the local area to where you're going to see this strike, they're going to start performing worse because the people around that area aren't making as much because they're on
Hmm.
strike. They're getting only what they're getting from the payments of the strike. Suppliers that are supplying the big three auto manufacturers, those suppliers are getting less orders in. That impacts them, and that could thus impact their employees. Tax revenue for the US could go down, right? Because now all of a sudden there's less tax revenue for us, for the government to collect because people aren't getting taxed.
Yeah.
The most important one is the cost of goods going up to the consumer. If me as a company, if I'm not producing as much because my employees are on strike, or subsequently I have to pay those employees more, and I want to keep the same profitability, I just simply raise the price of my cars. And
Hmm.
we've
Yeah.
seen that a lot, right? So we've seen the price of cars go up. When you have wage growth, companies don't like to lose profitability. So they just pass on the cost to the consumer. And it's this never ending cycle, which is what we've been dealing with. So
Yeah.
take my little.
Well, and it's kind of just the trickle down effect of all of this, right? And I think that that's where the conversation of as a worker you're upset because the big man and in the ivory tower is making all of this money being the CEO, and you want to demand more for your time, but at the same time the big man, I'm just going to put this in quotes here, the big person in the ivory tower is having to answer on a quarterly basis to shareholders, right? From a profitability perspective. And as you increase profits, he has to consider increasing price, therefore creating a conversation where we might have some problems on the supply and demand of said product. And, in this case, it's the auto manufacturing industry, which in all reality has seen a fairly volatile market in itself too, especially with the chip shortages and things of that nature.
Yep.
And so I think there's so much that ripples off into this, but I think the ultimate reality is, and I see this in sports very often too, is, with unions, you've got your bargaining agreements and there's peace for a couple of years. And then there's a point in time, whether it's a couple of months or maybe even a whole year where you're going to see some gridlock and you're going to see some, anger and some anxiety. And this is just a part of how, the union process works. So I think it's kind of more just recognizing, hey, these things happen from time to time, just kind of like a market correction. And you just got to continue to wade through it.
Yep. And this is, I don't want to dive too much into the Fed on this one because we've talked about it at length in the past, but this is what the Fed is pointing to when they're talking about the labor market is being a little too strong.
Yep.
You get a strong labor market, people spend more, and supports a higher inflation. Wage growth does exactly that. So, this is, they don't want to come out and say it, but this is what they want to quash. They want to quash these strikes, these demands for higher labor
Mm.
and higher wages, because again, it's just a perpetuating cycle that's just going to continue itself. And that's why, kind of flipping to, what happened this quarter. Um, July, they paused rates, right? They didn't raise anything with the idea that they were going to be data dependent, keep an eye on the data, and reserve the right to raise them more in the future. Then we start seeing all this economic data come in, the strikes go on, the government shutdown talks, which we're going to get to in a second here. But in August and September, just the last 2 months, we saw the market and the bond market repricing and believing the Fed's narrative of higher
Yeah.
for longer. That's why if you look at something like the 10-year yield, went from something like 4.3 to I believe it's above 4.65 this morning. It was, at least. So it's there's been a sharp correction in prices to finally meet the bridge of what the market expectations are and the Feds. And a lot of the things like the strike and the strikes have a lot to do with that.
Yeah.
Government shut, not so much.
Yeah, and on the fixed income side, I think at least over this quarter, the inversion between the 2-year and the 10-year bond has actually gotten a lot shorter, a lot smaller. So that is kind of an indication where we see longer term strategy coming into play, but also that 2-year, 10-year inversion, where the 2-year is yielding more than the 10-year, is normally a recession indicator. That's starting to shrink. So there's definitely some opportunity there as well. So one of the other things that I did want to talk about too is the government shutdown that you mentioned here, as we kind of were able to eke out a bit of a, I wouldn't call it a win, but a suspenseful end to the idea of having the government shut down on Saturday here this past week. But we've essentially delayed this for about 45 days, and I think the main thing is essentially the House and the Congress coming together and figuring out a budget deficit number, or just a budget number in particular. And what I would say is not only the short term, but honestly, the longer term impact of this budgeting situation, because for the longest time, and everybody's always talked about this, we haven't really had too much of an issue with operating on a deficit, because it hasn't truly mattered because of our sheer GDP and our growth and where we're at as a military might in the world. But we've slowly started to walk ourselves into a situation with interest rates, and the interest that we pay on the debt that we do owe by operating in a deficit. And I think that's one of the things that a lot of people are starting to get a little bit more serious about, but also a little bit more worried about, is the debt, or is the interest that we're paying on the debt alone. And the interest rate hikes that we've seen over the last 12 to 16 months are not helping that by any means. And so I'm really curious what we're going to see over in just the next quarter, just kind of this last half of 2023, to see what the guidance is, what ends up happening ultimately within, the Congress and the House, as far as that matter in particular, because I think it's going to project out a lot of things that the market will try to price in.
Yeah, I couldn't agree more. What they're going to do with the national debt deficit levels, the resolution they reach is basically just another band-aid. So we'll deal with that, like you said, in about
Either that or just higher taxes, to be completely honest. I've read a couple of different notes here over the last couple of days, where it seems to me like, and it seems to those other people, that that might be one of the only answers.
Absolutely, right? Because if you have a deficit, you are spending more than you're making,
Yep.
right? So think about it from your own personal perspective. If I'm making 40 grand a year and I'm spending 50 and I'm racking up credit card debt of 10 grand a year, the rubber meets the road at some point, right?
Yep.
I don't have the credit of all of our government, so mine will meet the road a little bit quicker. But
Yeah.
yeah, what's
Wish I had
essentially,
$1 trillion credit level.
yeah, and basically unlimited as long as you can print it. But yeah, you're combining the highest amount of debt we've ever had with a significantly higher interest rate than we were dealing with before. It causes them to spend less, which government doesn't like doing,
Yeah.
right? Being restricted. So yeah, like you said, two different ways to fix it. You earn more or you spend less. I just said
Yeah.
the government doesn't like to spend less, so we know which way that's probably going to go.
Yeah.
And the natural solution for that is that in 2026, Trump's the Tax Cut and Job Act that Trump put in place in 2017 expires at the end of 2025. It's a natural way for the government to increase taxes. How they go about it, who's to know? Do they raise it across the board? Do they raise it for the higher earners and tax the rich? It's who's to know?
Yeah. And I think the ultimate reality with all of this is we don't know what the future holds. But any sort of what I would call somewhat bleak of an outlook, you still want to invest. You still want to invest for the long term, and you still want to rely on solid financial planning based off of these topics, because these are the topics that you want to start talking about, start considering in your financial planning, and how I want to navigate these situations when they come to fruition or they get close to you know, either changing or adjusting or staying the same in the same light. You know, as you want to recognize what your alternatives are in that conversation, is despite any sort of negative outlook or honestly even positive outlook, you want to continue to invest and continue to invest in the long term. I think that's where kind of recognizing the difference between knowing what's going on and actually acting on what's going on. You don't necessarily want to just act on every single thing that's going on, or you're going to drive yourself insane.
Yep.
But you do want to recognize how some major things that are happening have long-term effects on you as an investor, but also how it affects your financial plan.
Yeah, I mean, at the end of the day, you can always go by the Warren Buffett, verbiage, whatever
Yeah,
it is. It's that, sell when others are greedy and buy when others are fearful. Three
yeah,
months ago, when the market was at its high for the year, there's a fear and greed index out there. We were on the verge of extreme greed.
yeah,
3 months later, we had a slight market pullback, less than 10%, and we are back into extreme fear.
yeah.
So, it's not time to complete, if your objectives and your time horizon has not changed drastically, neither should the method with which you reach those goals be.
Yeah. Yeah, absolutely. Well, that's it for today, everybody. Thank you so much for watching and listening. Really appreciate the time, and we're excited to see kind of what happens here through the rest of the fourth quarter. And we will see you guys on the next episode. Thanks.